Welcome, and welcome. We have a good one here. We are talking about FHA loans, and you might be before you log off. I'll say that first. This is actually going to be some stuff that you're going to want to tune into. I am talking about some secrets that mortgage lenders typically aren't going to tell you. That's probably going to be the second or third thing that I discuss about FHA loans. But first, I want to talk about two other things: some of the pros, some of the cons of FHA loans. FHA is widely utilized by many first-time home buyers. One, because of their credit flexibility. They generally have very generous credit requirements, if you will, lower credit requirements than what you may find on some other programs. But also, FHA has a low down payment requirement, 3.5% for FHA down payment on a home, for the down payment on an FHA loan, I should say. Another thing is that many down payment assistance programs, I'd venture to say most down payment assistance programs, fall under FHA financing or FHA loans. So if you're in a position where you need down payment assistance to be able to purchase that home, an FHA loan might be your way to accomplish that. And so we're going to talk a little bit about some of the pros and the cons. Now, I've already started talking about some of the pros, being one, you've got lower credit requirements. So an FHA loan, if you go down as low as a 580 credit score, you can get a 3.5% down payment. So that means that on a $300,000 home, $10,500 is the down payment requirement to purchase that $300,000 home under an FHA loan if you have at least a 580 credit score. And that's not bad, because a 580 is not a great credit score, but FHA will still let you purchase a home with a minimum of a 580 credit score and a 3.5% down payment. Also, with the FHA loan, in addition to the credit requirements and the minimum down payment, the mortgage insurance is not based on your credit score. So when you look at mortgage insurance is something that's required on pretty much every single mortgage loan out there where you put less than 20% down on the home, which most people that purchase homes don't put 20% down. Most people put less than 20% down. So when you put less than 20% down, mortgage insurance is required on that home. Mortgage insurance is required on all FHA loans. Even if you did put 20% or 40% down, you still got to pay mortgage insurance on that FHA loan. However, it's not based on your credit score. And that could end up saving you, particularly if you don't have great credit. So if you're someone with, let's say, a 620 credit score, you could end up paying hundreds of dollars more for mortgage insurance every single month as part of your mortgage payment if you went conventional versus FHA, because with a conventional loan, your credit score greatly determines how much you're going to pay for mortgage insurance. But with an FHA loan, you will rather pay the exact same rate as someone who had a 750 credit score. If you had a 620 and someone else had a 750 or 800, y'all are going to pay the same in mortgage insurance, because FHA is not based on how much your credit score is or how high your credit score is. It's based on the percentage. It's a percentage of the loan amount, and that's how FHA does theirs. So that could end up being to your benefit, is having lower monthly payments for that mortgage payment, particularly if you don't have great credit. Always strive for great credit, because the benefits far outweigh maybe some of the stresses that you got to go through to get great credit, paying your bills on time. Who wants to do that? But anyways, joking. You should always strive to pay all of your bills on time, and strive to get that great credit if at all possible. But in any case, with FHA loans, you've got the low down payment, you've got the interest rates that are typically a little bit better with FHA loans as well. That's another pro when you compare it to a conventional loan. So FHA compared to a conventional loan, in general, you will find lower interest rates on the FHA side of the home. And one thing I didn't mention, FHA is a government insured loan. That doesn't mean that the government's giving you money to purchase the home. That means that the government is insuring the lender that they will get a certain percentage of their money that they loan you back if you default and stop paying on the mortgage. So the lender loans you $300,000, $400,000, and you stop paying on the mortgage payment, then that lender has to sell that home in a foreclosure sale. And if that home doesn't sell for enough to cover everything that the lender's owed, FHA insured loans means that the government will step in and compensate that lender, a certain amount to help make that lender whole for doing that loan. So let's talk about some of the cons of the FHA loan. One of them we already mentioned, the mortgage insurance. Now, it's hard to say pro or con when it comes to mortgage insurance, because mortgage insurance without it, you wouldn't be getting a loan, period, to purchase a home. Mortgage insurance is one of those things that gives a lender confidence to be able to loan you money with such a low down payment. So mortgage insurance definitely is to a benefit. However, I will say the con of it when it comes to an FHA loan is that there is one thing that you pay, which is called an upfront mortgage insurance premium. So you're going to pay, typically it's 1.75% of the loan amount, at least currently. You're going to pay that upfront, and usually it can be financed into your loan, but you're going to pay that, and that's just the cost of getting an FHA loan. That's part of how the FHA program is funded, is through that upfront mortgage insurance premium. So that gets paid to FHA as a one-time payment. And then you have the monthly mortgage insurance, which is part of your mortgage payment. Now that monthly mortgage insurance premium that you pay with FHA loans, that does not go away. If you do a conventional loan, what you owe on that home is 80% or less of the value of the home, you can actually request to have that mortgage insurance removed. But on an FHA loan, it does not come off if you put 3.5% down on that home. So the only way it comes off with an FHA loan is if you put at least 10% down on the home, and even then you still have to pay mortgage insurance for 11 years. I don't even know where they got that number from. 11 is just so random. But if you put 10% or more on a down payment for an FHA loan, you still have to pay mortgage insurance for 11 years before it'll go away. And if you put 3.5% down, which is what a lot of people do, 3.5%, then it never goes away. For the entire time that you have that FHA loan, you're going to be paying mortgage insurance. And so that's a little bit on the negative side. It'd be nice if eventually it worked like conventional loans where, with that mortgage insurance can fall off and it's not needed for you to pay that anymore. But that's not the case with FHA loans. So those are some of the pros, some of the cons of FHA loans. I'll talk a little bit about loan assumability. Now, this is that secret that I was telling you to hold on for. So when it comes to mortgage assumability, loan assumability, this is one thing that a lot of people don't do. They do not consider assuming the seller's mortgage when they go and purchase a home. What do I mean? I mean that if you have a seller that has a mortgage on a home and you want to buy that seller's home, you could actually just take their mortgage rather than going and getting a brand new mortgage from a mortgage lender. So you go and find a home, and a lot of sellers, a lot of people today even are sitting on 2%, 3%, 4% interest rates that they got from the pandemic. In 2020, 2021, 2022, some of those people still have really low interest rates. So because of that, if you're going to purchase a home from a seller, it might be worth it for you to ask them, hey, out of curiosity, is your home under an FHA loan or a conventional? Because a lot of conventional homes, you can't assume them. You can't assume the mortgages. There might be a few out there that you can, but a lot of them you're not able to assume. But with FHA loans, a lot of government loans, those loans can be assumed. And so if they say, oh, I'm under an FHA loan, or I'm under a USDA loan or a VA loan, then it's like, okay, cool. What's your interest rate? Might be the next follow-up question. Because if they come back and they say, oh, I've got a 3.5% interest rate, or I got a 4% interest rate, guess what? That could be a way for you to qualify to be able to purchase that home and have a much lower monthly mortgage payment. Because now, as long as you can qualify for the mortgage payment that they currently have, you qualify to purchase that home, then let's say, for example, if that home's worth $400,000 and they still owe $300,000 on the mortgage. If you can qualify to purchase that home, you can just assume their $300,000 loan at a 3% interest rate, 4% interest rate, whatever the interest rate is they have. You just assume that interest rate. So now you get a $300,000 loan at a 3% or 4% interest rate. And now you just have to get a smaller loan to cover that other $100,000 to get you up to the $400,000. If it's a $400,000 home, you just have to get a smaller loan now. And that smaller loan will be at a higher interest rate because it's going to be based on the current interest rates today, which are currently around the sixes, the low sixes. But Now you only have about 100,000 that's under a 6% interest rate, and 300,000 that's under like a 3% or a 4% interest rate. So you're talking about saving hundreds of dollars a month on your mortgage payment by doing this. I'm telling you, this is a much better way to purchase a home, a much better way to get a low interest rate, especially if you're in one of those situations where you want to purchase a home, but interest rates are kind of prohibiting you from being able to purchase quite at the level of where you want to purchase or where you would like to purchase. This is one way that you can actually get your foot in the door of those homes that you currently don't quite qualify for yet, is by assuming the interest rate of the seller that's selling that property, or assuming the mortgage, which in addition you would also get their interest rate for that home that seller is selling. So that's something that I really wanted to leave with you, because that is huge in terms of allowing you to be able to get a higher purchase price, get a lower monthly mortgage payment, save you hundreds of dollars a month all around. I mean, even a 1% drop could save you $200 a month. Imagine being able to get a 2% drop, and there now you're paying 4%, or a 3% drop and you're paying 3% interest rate rather than a 6% interest rate. That could be huge. You're talking about possibly saving, $450, $500, $600, depending upon the purchase price of that home, literally on monthly mortgage payments. What could you do with an extra $500 a month every single month that you don't have to put toward the mortgage payment? You can just go and, do something else with it. So you could save it. You could invest it. You could build wealth off of being able to have $500 a month that you can stash away and invest and grow into, $10,000 eventually, because $500 a month, I mean, in, a couple months, you got a couple $1,000, in 4 months, you got $2,000, excuse me. And, it's going to continue to, compound from there. And before you know it, if you're growing it, you got 10,000, 20,000, 40,000. It's just growing over the years and over the decades. So this is one way that you can really just get yourself, off to a great start in the direction that you really need to be in. So that's what I have for you. I wanted to give you some of the pros, some of the cons of FHA loans, so that you have some information moving forward on if this is the route that you want to take. Be tuning in next week. We're going to talk about conventional loans, some of the pros and cons of conventional loans as well. And that'll give you a better perspective in terms of, hey, do I want to stick with the FHA route, down payment assistance? Because there are some things that you might want to consider when it comes to conventional financing that could be to your benefit as well. So that's what I have for you. Thank you for taking the time to tune in. Make sure you tune in on Fridays. We're dropping another episode of the Greatest Asset Community Podcast. Then be right back here at 7 p.m. Eastern Time next Tuesday for another episode of Home Finance Hacks. Till next time, take care, be blessed. We'll see you